to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Interesting out there. It's always something's always going on. Something's always changing. Been talking to an awful lot of people this week, that are finally beginning to realize that interest rates are too low and may stay that way. I mean, that's the big thing. What do you do? And there's so many issues related to that, and a lot of people are waiting, hoping, against hope. I believe that interest rates are going to go up. Not on loans. They want the loan interest rates to stay low, but they want the CD rates to go higher. And they don't understand that if interest rates go higher, the loan rates are going higher. That'll slow down housing. But so it's quite a quandary that we find ourselves in. Very difficult to be able to live off of 1.5%, which, according to my research over the past few hours, are the highest rates that you can get across the country in CDs. Treasuries are paying significantly less than that. And here, I'll pull up the treasuries. So a 30-year treasury bond closed, the yield yesterday was 1.23. 1.23. You got to wait 30 years, by the way, to be guaranteed that you get your principal back. 10-year note, 0.568. I really did not think I would ever see this. I really had never imagined in my wildest dreams when I was young. Because you got to remember, when I was going to when I started into college, you could get an 18% interest rate in a money market. Okay, buying government securities. 18%. And that was kind of at the peak. And it started coming down. So all through my college and the first few years that I was in this industry, interest rates were substantially higher than they are today. I mean, by a mile. And would have never thought that they would get this low. So when I see the data and I see some highly respectable publications putting these hypothetical portfolios out using data from 20 years ago, that they're going back 20 years, and saying this is what you should be able to expect to get. No. That just proves to me that you're a journalist. You're not never really studied economics. Now, maybe you have. But if you have, why would you put that in the article? You're building up false expectations. It's false expectations, because when you look at the average rate of return on bonds over that time period, it was substantially higher than they are now. When I first went out on my own to form Bullington Capital, I was able to get better than 10% a year just in interest, on high yield bonds and real estate investment trusts. Those things are a fraction of what they were back then, and the volatility is about the same as the stock market. The volatility back then, the fluctuation, was about the same as the stock market back when I was buying them then. And the stock market's long-term average return was right around 10%. That's why I owned the bonds, because you're getting 10% in income. So you were matching the return with actually the risk was slightly lower, in real estate investment trusts and junk bonds. That's what they call them. High yield securities. The street slang for that is junk bonds. So anyway, different day. I mean, it's wild. You could get 5 or 6% CDs. And if interest rates were to ever go to 5 or 6%, let's take a look at why the likelihood of that happening is not super high. And I feel bad. I feel like I'm always the bearer of bad news, but actually there's some good news to this whole thing. And we're going to get to that next. But right now, the public debt is a little over $20 trillion, about 20.6 trillion, according to the Treasury website. When you hear about the total debt being 26.5 trillion, that's true, but a lot of that is owed to other departmental agencies, most of it to the Social Security Fund. So they've been borrowing out of the Social Security Fund to pay for other stuff. That sounds lovely, doesn't it? But it's not, I'm telling you, it's not that big of a deal. It's really not. Those are big numbers, absolutely, but so is the economy. The economy is huge. And it would actually have to go up a little bit to be able to match the debt. If you measure the debt against the total economic output, the debt would actually have to go up. It would have to increase a little to match the level that it was in 1945. Think about that for a second. These are very similar to ratios that we held back in the 1940s. So is it time to panic? No. I mean, think about it. How well did this country do from 1945 to now? How much easier are our lives? You know, people that are in the lower income categories lead lifestyles that rich people couldn't afford back in those days. And think about that for a second. That's amazing. That's absolutely amazing to me. But I get it. You know, there's this thing called inflation. And there's been wage inflation. The average worker makes more per hour than they did back then. That fluctuates every year, by the way. But I'm just looking at this stuff and going, wow, you know, it's really not as bad as it seems. Is it challenging? Yes, it is. Super challenging. A 1.5%, CD rate being amongst the highest in the country. Wow. You used to be able to take when I first started, the CD rates were actually 10%. Now, I remember when they went down to 8%. You would have thought that, people were, having heart attacks. And, oh my God, it's going down to 8%. And I just think about that today. It seems kind of silly. But anyway, that's one of the reasons that, it's going to be more challenging to A, accumulate enough assets to retire, B, to make your money last as long as you do, because the returns are definitely lower. Look over the past 5 years, okay, that's a fairly recent time period. The only category that's done as well as its long-term average has been the large cap growth. Every other category has done worse than its long-term average. And not by a little. Some of them are by a lot. So that's a little challenging, very challenging. And but that's what we've got to deal with, and there are solutions. We're going to talk about some of those solutions. By the way, if you'd like to call in, 216-901-0945, 216-901-0945, or if you hear something here that you'd like more information on, feel free to go to my website, reach out. I'll try to get back to you as quickly as humanly possible. And I'm here to tell you, there is a silver lining to all this stuff. So you got to stay tuned to find out about it. And I'm going to take a phone call right now. I got John. John, you're on the Bullington Capital Report.
Yeah. Hi, Bill. Thanks for taking my call.
Sure.
I called last week, and you mentioned about the CDs, and the Fidelity brokerage. And then I heard you today, the rate's 1.5% net. Anyway, so I went on the thing, and, they have new issues. And then they got secondary CDs.
Yes.
And you can go, anyway, I looked, and I went from a year from.
John, if you could call us back, your phone call, you must have been on a cell phone. The phone got dropped. The call got dropped. So I'd really like to hear what you have to say, by the way. Leave me hanging. Yeah, I'm used to that, man. You ever drive up? What is it with Bath, Ohio, and Brecksville? They refuse to let cell phone towers go up. That's what it is. You guys got to talk to your trustees there or your councilman, because I am so tired of my calls getting dropped every time I drive through there. And I know in Bath, I used to read about it in the local paper. I don't get that paper anymore. But they don't want cell phone towers there. I'm like, are you kidding me? So basically, you're driving through these areas and there's no coverage from anybody. I've had all the major carriers over my last 20 years. And, I can't tell a big difference between the carriers, but I can tell you what. You drive through certain areas around Cuyahoga and Summit County and the calls get dropped. So anyway, sorry to vent over that, but it's very frustrating. Anyway, so we're talking about CD rates. You can go to Fidelity. And I had this. I'm glad he brought that up because I had a conference call. And Fidelity really bends over backwards to service. They're a very good firm. That's one of the reasons I use them as a custodian. They're actually the major custodian that I use now. I use others, but they're the major ones. Really depends on what somebody wants to do. So anyway, they put me in touch with head of research for the fixed income department. I'm like, what? There were only 4 of us on the call, and I was the only one that didn't work at Fidelity. But so I was very pleased, and he told me the same things, was reiterating the stuff that we've been talking about here. These guys get they get audiences at the presentations done by the federal government, by the Federal Reserve. And incidentally, the Federal Reserve has to release information to the general public all at the same time. They can't give them a wink and a nod and an edge and all that. But they do get audiences, especially since you're representing one of the bigger financial firms in the entire world. So anyway, his comment when I asked him, okay, what was the feeling that you got from the last meeting that the Fed had? And he said, well, the Fed's statement was interest rates are probably going to remain low for the foreseeable future. And then he paused, and I'm going, okay, that's my clue. That's my hint. Same thing we've been talking about. Interest rates are pretty low. I mean, think about this. So if you had $20 trillion in debt and you were able to choose your own interest rate, what would you choose? What would you do? Probably not offer to pay 4 or 5 times more than you're paying right now, right? Well, I mean, why would you do that? I know, out of the kindness of your heart. But unfortunately, if it were me, I probably would do that. But I don't have control over that. I just have to deal with it. And, having a low interest rate like that, probably going to be with us for a while. So my point is, when you're looking at these illustrations from the past, you need to factor that in. Bonds are not paying anywhere close to what they were paying 10 years ago, 15 years ago. When you look at a projection that goes back 20, 30, 40 years, those rates, the chances of that being repeated in the bond markets particularly, they're very slim. Now, I know hope springs eternal, and the Browns may go to the Super Bowl next year, but I wouldn't stake my life on that. And when you hang around in fixed income at those rates, there's only one reason to have fixed income in your portfolio right now. Okay, it's so that your entire portfolio doesn't fluctuate like the stock market does. That's why you have bonds. It's a stabilizer. And by the way, bonds still fluctuate. They just don't drop 30 or 40% or 50% typically. Well, at least they haven't, knock on wood. But they typically don't drop like that, like stocks do. So it's a buffer for your portfolio to try to give you some peace of mind. And I'm going to tell you that the most popular mix has been a 60-40 or a 65-35, right in that range. 65 stock, 35 bonds. I think if you're going to make more than 3 or 4% as an average annual return in an interest rate environment where you're getting 1.5%, and that's if you get the highest rate, the averages are right around 1. You got 30 or 40% of your money, 35 or 45% of your money that's earning 1%, and you're paying a management fee. Your return is zero. Your return is zero. So you're talking about returns that just because the bonds are so low that your returns are going to be 30 or 40% less than what they have been over the past 30 to 40 years. So what can you do about that? Well, there are a couple things. That's one of the reasons I've been talking about the Nationwide product. And Nationwide's not the only company. There are other companies. There's a coalition there. But it's why I've been talking about that, because it offers a viable alternative to people who are looking for an alternative to a 1.5% 5-year CD. Okay, it's an alternative. It's not a CD. It doesn't even work the same way. So when you're putting it in there, if you're going to have that, and I already invested it, I sent them money. So if you're going to put money into it, you've got to understand it. And I'm very particular about that. I won't let somebody go forward into an investment unless I feel like you've got to convince me that you understand it. Think about that for a second, because I don't want those calls coming saying, "Hey, I didn't know that this was the way that this worked." And typically, what you're doing is you're buying an income stream, which essentially isn't that what we're doing with all of our investments? Aren't we saving up our money so that one day we can stop contributing to it and turn and start taking income from it? Isn't that mostly what we're trying to do? Okay, so from that standpoint, I think it makes perfect sense, but not for everybody. If you're below the age of 50, if you're actually below the age of 55, okay, then I'm not sure this makes sense for you. And I'm going to tell you that. So people ask me all the time, well, what's the difference between you and all the others out there? Well, first of all, I work really hard. Some people do. I get it. And I guess I'm going to have to continue this thought after we come back from these commercial messages because I hear the music. You're listening to Bill Bullington right here on 1420. Stay tuned because I'll be right back.
I've read the story. I've seen the movie. I give to charity and tithe my 10%. These I remember, but I so easily forget. Once there was a holy place, evidence of God's embrace.
And we're back. Hey, you're listening to Bill Bullington here every Saturday morning from 11 to noon. Feel free to check out my website, bullingtoncapital.com. If you'd like to sign up for our newsletter, you can do it there. Feel free to call me if you've got a question that you can't get to me on the radio for the... and I've got a caller coming in right now, and it looks like I'm talking to another Bill. Hey, Bill, are you there?
Joe.
Pardon me?
No, this is Joe.
Oh, okay.
Oh, Joe.
All right. Sorry about that. That was
It's okay. It happens to us all the time, especially me. I got to ask people all the time because I think they slur their words, you know?
I hear you. I can't tell you how many people call me Burlington, Burlingham.
Yeah.
It happens all the time. But
I got a couple of things, Bill, about
Sure.
your comments on what you've been saying today.
Okay.
You're talking about these cell towers.
Right.
You're absolutely right. If you go down State Road Hill over here in Parma,
Oh, yeah.
State
Yeah.
Road Hill or Broadview, I think more it's Broadview Road Hill because I'm right around the corner from that. I live over here in Seven Hills, and I'm on Broadview Road Hill all the time,
Right.
going between Pleasant Valley and Brook Park Road or Snow Road. Going down that hill, I lose my cell calls almost 90% of the time, unfortunately.
Yep. I hear
And
you.
same thing in my own house. I
Yeah.
mean, I'm a mile from a tower at I-77 in Pleasant Valley, and I can't even use my own Verizon. Oops, if I can use a name, use my own cell phone in my own house. I always tell people, I laugh. You know,
Right.
I don't know if there was a commercial years ago or what, but in order for me to use my Verizon phone inside of my house, I have to go up to the second floor of my split-level house, hang out the southwest window of my bedroom in order to be able to use it. You know?
Wow. That's funny.
That is ridiculous.
Oh, man.
I'm exaggerating a little bit, but in effect, that's it. I have to sit in my driveway out in front of my house to even try to get one signal strength little bar, on it.
Yep.
It's terrible.
Yeah.
The other thing I have to compliment you too, Bill, about you're talking about Fidelity Family of Funds.
Right.
That Fidelity company, I have to agree with you 110%. I tell all these other families, Matthews, T. Rowe Price,
right,
BlackRock, all these others, they all have normal business hours, 9 to 5 or sometimes 9 to 8, but they don't work 24 hours a day like Fidelity does.
Right.
If I'm up at midnight, if I'm up at 2, 3 o'clock in the morning and I want to check on my Fidelity investments with them,
right,
somebody is always there to answer the phone for me. I can't believe it.
Yeah.
I tell all these other families, well, you guys, whenever I want to check on you, I got to make sure I get there between 8 and 5 to get my answers from you. Fidelity, I can let go till midnight and call them up, and somebody's always there. They always have an answer for me, at least as far as what my investments are with them, the funds that we have in our family. They are terrific.
Yep. Yeah, I agree. The only reason I use other custodians is because some people have preference for it, and there's one thing that I can't do at Fidelity that some people want, so I have to use another custodian for that. And but it's getting less and less popular, which I think is a good thing. It's actually being able to do a super customization of a portfolio, and everybody wants. I want to be different. No, you don't. Actually, you want to be in the right programs. I wouldn't want to be in just a cookie cutter, but by the same token, to do individual stocks today, you don't have time. Nobody has time. They move too fast for that. And I still do individual stocks, and I can tell you, I can barely keep up with it. And I do. This is all I do. I live literally 5 minutes from my office. That was by design, so that I could spend more time working and then would have the time to be able to do this too. So it's I don't know how anybody with a normal life would do what I do. I just have no idea. But I do. I really like Fidelity a lot, and they've been very helpful. That talking with the guys, I was amazed that the internal guy that I work with there set that meeting up. It was great. It was a phone meeting, and they've done that for me over the years. So I really think they're a good firm. Absolutely. And if you want to find out where true interest rates are, like I said, you can just log on, go to their website, go to their investment products, look up the fixed income, and you can see that's exactly what I'm talking about. I just pulled up 5-year brokered CDs, and I didn't want to pay a premium on any of them. So you can pay more. You can pay more than $1,000 for a CD if the interest rate is higher. Then they do this yield to maturity calculation. It's all pretty complicated. So I just eliminated that part of it. And the CDs without a premium right now they're like 0.7%, and those are the better ones. This is what I'm kind of talking about. I've been talking about there's a product out there, and it's not suitable for everybody. If you're in your 40s or you're in your mid 30s or you're in your early 50s, that nationwide thing I've been talking about is probably not the best idea for you. Yeah, but if you're within 10 years of retirement and you're looking at a 0.7% CD, maybe you ought to be looking at that, because it's a viable option. And I get it. I've had a lot of people look at it, go, yeah, I don't want to do it. And no problem. That's not my job. My job is not to convince you to do what I think is best for you. My job is to lay out all your options, explain them the best of my ability, let you pick which ones, and then I take over and I'll manage that going forward. But I'm not supposed to be sitting there trying to tell people to do something against their will. That's not how my business works. And other businesses where the guys are just salesmen, that's how that works. Their job is to sell their product. My job is to try to hook you up with the right product for you, and I have to service that on an ongoing basis. So it really helps when I try to get people in the products that I feel like are the best for them. Now, they don't have to agree, and they don't have to listen to the advice. Most people don't. Quite frankly, they listen to what they should do, and then they do what they want, and that's fine. As long as it's reasonable. And so anyway, sorry to.
And Bill, I think you're absolutely right about those interest rates. A couple of our local banks here in town, if you look at what they're paying, it's
right.
0.01 or 0.03%. You know,
right.
People actually look on their statements. It's amazing, And what's more amazing to me is how these credit card companies
right.
can still charge people with their credit cards 15, 18, over 20% interest.
Yeah.
On their credit card balances.
Yep. If you've got
how the heck did they get away with doing that when money has been so cheap for the past 10, 15 years?
Well, you know what? That all comes down to their own underwriting, because when they lend people money who can't afford to pay it back and hoping that they collect a portion of what they lend them, they have to keep the rates high on everybody to make up for those people who can't pay back. So it's really a lot like insurance, and it's very similar. I mean, they're tracking their own personal experience. Hey, we've lent these people with this credit score at this age and with this amount of income, this amount of money. How many of them are going to be able to pay it back? How many aren't? How much interest do we have to pay to cover for all that? And that's how it works. So.
Well, I guess that's why Third Federal here in town, our local bank that has really grown over the years and has expanded into Florida, because so many of us snowbirds go down to Florida.
Sure.
I'm just starting lucky enough. My daughter moved down there recently because she didn't like the snow. So now we have a place to go during the winter months.
Nice. Yeah, that's awesome.
But Third Federal, hey, you cannot get a home mortgage if you do not have a 700 credit score.
Right.
Up until about 2000, they would work with you a little bit. My own personal experience with them.
Right.
If you had another CD someplace else, or if you had another piece of property, you could pledge towards your new mortgage. They'd work with you.
Right.
But nowadays, if it is a cookie cutter.
Yeah.
If you don't have a 700 credit score, they put your information into the computer. They hit the button. Whatever the button spits out, whatever the little black box spits out.
Yep.
Hey, if you don't fit in it, sorry. And they still hold to that true today. They will not loan anybody without a 700 credit score.
Right.
You're right.
And it's there's nothing wrong with that. That's actually how they choose to do their business, and I think it's a very good method. I'm always impressed by insurance companies who do the same things, which is exactly what they do. How many of these guys in this particular profile end up filing claims, and what are the average dollars amount so that they can price their policies so that they can stay in business and earn a profit for all the shareholders who, by the way, if you don't have money in mutual funds, then you probably aren't going to make much at all, and you are a shareholder. So I hear that, people talking about, the shareholders, they're evil. No, actually, we're all shareholders. We all have money in 401ks, in retirement plans that are invested in stocks, whether or not you even know it. If you have a pension, STRS, PERS, you're invested in stocks. You just don't know it because they're not showing you. You have to go in and inquire about how that money is invested instead of just looking at the statements showing what your income's going to be.
Exactly. If you have all your money saved in the bank, well, unfortunately, it's a little more...
that'd be rough. Yeah.
In this day and age. Exactly right.
Yep.
Well, Bill, I really enjoy your show every week. One other thing that I discovered, too, is a couple years ago for the first time, is that this Morningstar has a site, has their website.
Yep.
And they just, if I might be able to let all your listeners know if they'd like to look into it, they have a website that you can put in, and you can create these charts, these funds of all of your investments. You put it in, and this is free. They have another premium. What do I want to say? A premium account.
I use Morningstar Office Advisor. It's a $10,000 a year. Actually, it's about $12,000 now. And so I'm really familiar with them, and I think they do a great job on a whole lot of stuff. And that's one of the sources I use for this show, actually.
One of the things that I just discovered looking to, because I've only been using it for 2 years, and I just discovered earlier this year, one of the categories that you can track on your chart for your funds is something that tells you what the performance has been for the past year to date, 1 year, 12 months, 3 year, 5 year, 10 year.
Right.
I look on there, I look at their, and I'm starting to think that their actual stars that they use,
right.
their star ratings, to me sometimes doesn't have an effect.
It doesn't. It really doesn't. And they've talked about that, in the past, and they haven't promoted it nearly as much as they used to.
Oh.
Yeah. So they're honest. I mean, there's like, hey, we thought the 4 and 5 star rating would really help, and it hasn't. so yeah, you got to take that with a.
I used to base my thoughts, my feelings about a particular fund,
right.
if it was good or bad, on that star
I
rating.
know a lot of people did, and but I, like I said, they were very honest about it. They came out and said, it hasn't really helped much, and because when you only look at performance, and if that is the only thing you're probably not going to do that well in the long run. In the short run, you might get lucky. But in the long run, you're going to actually have to know a little bit more than the past performance if you want to continue to do well. And,
right.
And that's the problem with that whole thing. But hey, Bill, I got to run. I got to call it.
Thank you so much for your show. I'll talk to you again, and I look forward to seeing you in person one of these days.
Okay, thank you. Have a good day.
Take care. Bye-bye.
Bye. And Matthew, sorry for the wait there.
That's all right. Hey, Bill, I kind of want to ask your opinion on an individual stock and your opinion on that, and then another thing. Well, first of all, so Fastly, and I had picked it up in the middle of the whole, COVID thing. It was kind of high flying there for a little bit, and then obviously this whole thing with TikTok and Microsoft.
Sure.
Kind of like doing a little bit of research on Jim Cramer's COVID portfolio, but I was kind of asking you what they beat earnings and all that, but obviously it got hammered. I dumped it out of my trading account and my Roths, but just kind of wanted to know what you feel the long-term prospect of a company like that is.
Okay, I'm glad you said long-term. Okay, and by the way, the Look Out for the Bull website that Mike Seeger runs, he posts the stocks that are moving up real fast, really quickly. You can read all about it. It's called Look Out for the Bull. That's been coming up pretty regularly, and I've watched this thing and just fly. And here's the thing about a stock like that: if you're going to invest in, it's not a good long-term investment. The market cap, that's the value of the stock. Okay, if you added the number of shares together and then multiplied it by the share price, that's basically what it's selling for. The entire company's stock is selling for today. That number is a little over $8 billion. Hey, I hear the music. Can you hang on there for a second, Matt?
Yep.
Okay, Thanks. I'll be right back. You're listening to Bill Bullington. I'll be back in just a couple minutes right after these commercial messages.
Call my name and woke me up. You called my name and let me out. And when I chased one more mirage, till I was tired and parched again, you gave
And we're back. Hey, Matt, you still there?
Yep.
Okay, so I
Yes,
looked
I'm
up.
here.
Pardon me?
Oh, I'm still here. Sorry.
Okay, no problem. So I looked up Fastly, And so the market value of all the stock, if you multiply the shares by the share price, that's what we call market capitalization. It's the total value of all their stock. And in other words, if you paid its current price and bought every single share, that's how much you would pay for it. It's $8.2 billion.
Okay.
Their revenue over the past 12 months was $246 million.
Okay.
So if you take the revenue or the price that you're paying for the company and divide it by their sales, it's currently selling at 30 times their annual sales. Now, let me ask you a question, Matt. If somebody offered you 30 times your annual salary, your total, what you made last year in the last 12 months, to buy your job from you, would you take it?
Oh, yeah. Right.
Yeah, like tomorrow. Like, can we? Yeah. See, the average, long-term average for the stock market is 2 times sales, not 30.
Right.
That makes sense? So this stock is overvalued by a lot.
Right.
Okay. It's a great company, but it's people are paying prices for it. That stock shouldn't sell for that much right now. It should be substantially lower than that, but everybody gets excited. Their revenue growth, by the way, was 60% year over year. That's why everybody's also excited about it, and it's actually ahead of itself. Now, these are my opinions. You are entitled to your own opinion, but I would not, if somebody were to offer me 30 times my gross revenue for my company, I'm telling you, the next thing you'd hear from me would be my obituary, because I would quit and I would run away.
Right.
I would be. No, I'm kidding. Actually, I'm not kidding about the taking the money. 30 times my company's, my total, not the profit, their total sales, their total revenue. So it's that's one of those things. It happens from time to time. A company will come up, and as I mentioned, this has been pointed out by the guy that runs the Look Out for the Bull website every day, and rightly so. If you purchased it the first time it came up on the list, you'd have a nice profit. You'd have gotten stopped out about a month and a half ago, and then it turned around. It went to a new high, which is very frustrating for people. And then if you bought it that time, you would have gotten stopped out in a matter of days, which then you would feel better about it. You're like, whoo. But it's overpriced. It's a great company. And the stuff that they're doing is cutting edge. They're growing very quickly. The price is ahead of itself. So
well, and that's where, I dumped it, for a little bit of a gain in one account and a little bit of a loss on others. So I'm not,
Good deal.
It was picked up in the 70s, low 80s. So I'm like, okay. And I was watching the options contract that, 115. And of course it shot up past there. And, and of course, if we, like you said, if we all had a crystal ball, but I dumped it with the mindset of I'm going to keep an eye on it and kind of keep watching it again. And,
you might want to look out for that. Look at the Look Out for the Bull, because we narrow the list down. It's only $10 a month. Right now, I've been losing money on it ever since I started it.
Yeah,
like the cost of putting it up there is more expensive than anything we're making. At this rate, we're not going to be profitable for another 5 years. But anyway. It's only $10, and we explain exactly how we're doing it and how these stocks come up on these lists. And Mike publishes that list every day. It's pretty cool. It's fun, and you did it exactly the right way. If you go and read the training on there that's free, you're doing 95% of what we taught. That other 5% is probably going to help you quite a bit. In fact, you wouldn't have to subscribe to it. We teach you exactly what to do, and you can find other screeners out there if you wanted to set it up yourself. But at $10, I think it's
on your website.
Yeah, that's at Look Out for the Bull. That's a different website.
Okay.
Yeah, but I'm impressed though.
I know we run out. No, I've been investing for about 23, 24 years,
nice.
And but the other thing too, and again, I always have a little portion of my account and a little bit speculative and hedging, so gold and silver in the form of an ETF, and I've owned physical silver and physical gold over the years for different reasons, and I've traded like the SLV, and I'm looking at, and again, and I know that there's different factors and why they both go up and down. They don't go lockstep, but with everything going on with China and going into the election, a portion of it looking at either SLV or GLD. Mm-hmm. And what your opinion is on that?
Those are really tough. There's not a lot to look at on fundamentals,
Right.
And you had those are incredibly difficult. So yeah. I tend to avoid anything that I don't have a pretty significant edge in. If I can't get a good edge in it, then I'm not going to follow. Now, I have a client who follows gold yes. So I'm asking him what to do because I don't follow it. I don't have time to do that with everything else that I'm doing. And it is hard. And I understand that he's going to be wrong a lot because everybody is. When there's a speculative nature, the speculators make money by minimizing their losses, and occasionally you get a big winner. That's basically how it works. So, and you've been doing this long enough to know that. I can tell by the tone of your voice. That's pretty cool. So if we can,
I have a love-hate relationship with gold and silver, and I remember Warren Buffett basically saying, it's a lump of nothing that doesn't pay dividends, doesn't pay interest, and it's like I said, I love it and I hate it at the same time.
Yeah.
So, well, thank you, Bill, and you have a great weekend, and God bless. Sir.
Oh, thank you. You too.
All right, take care.
Thanks.
Bye-bye.
Bye-bye. Oh, nice call. Nice guy. So, I barely talked about this whole nationwide thing. I've been getting a lot of calls, and rightly so. You look at the distribution rates that it's paying, it'd be really hard to match that with stock investments that are 100% actually. It'd be hard to match it as a guarantee, but what you're doing is you're converting an asset into an income stream. That's what you're doing. And to abandon that strategy, you can actually get back out of it if you want to. It just wouldn't make sense in most cases because the penalties that you would pay for abandoning that. So you're not going to hear that from a lot of the guys that talk about this stuff. But I got to tell you, because I just can't have that on my conscience. I'm sorry. But you get into it, you're looking at it. If you're looking at it for the right reasons, this is going to provide a certain amount of income for this portion of my portfolio, which I would normally be reserving for something that's more conservative. And the conservative investments today are paying so little that this makes a lot of sense to take a look at. So again, if you hear something here you want to talk more about, feel free to go to my website. Call into the station. I know you can't call from your car most of the time, and please don't try to call me while you're driving. But you can go to my website, bullingtoncapital.com. It's a good, viable option for where we are today. Where we are today is that interest rates are low, and as our Fed president said, for the foreseeable future, you're going to stay low, and there's no telling how long that's going to be. I'm looking at, I think, minimally, the next 5, probably the next 10 years. That's how long the interest rate, and there's nothing saying that they couldn't go lower than this. I mean, some countries, their central banks are charging people to keep their money safe for them. They're not even paying them any interest. It's actually going in at a cost. So we're not there yet. I doubt that I don't think it's probable that we're headed that way. And I think given today the current options, that these make a lot of sense, though they're not for everybody. So, and that's one of the reasons that having an advisor today is probably more important than it's ever been. It was easy 20 years ago. You could take some halfway decent mutual funds, some halfway decent bond funds, and you were good. Those days are over. It's getting more complicated because the whole world's a little more complicated than it was then. And you can thank the internet for that. It has really sped up a lot of progress in a lot of different areas, and a lot of things it's just made incredibly complicated. And not impossible, it's just complicated. And I think you really need to know, what are you up against? And to that poor CPA who got upset that I was talking about you need $1 million to create $50,000 in income. Well, that's aggressive, by the way. And I reached out and apologized. I said, yeah, I'm sorry. The numbers are actually higher now. You actually need more than $1 million to generate $50,000 if you want to do it without taking an enormous amount of risk. Notice I didn't say not take any risk. You still have to take risk for that. And that is the sad part, because everybody's seen those ads or those long-term returns on the funds of 9, 10, 11, 12%, depending on the time period that you're looking at, and they're using that to go forward. I don't think that is likely to happen. I think that the returns are going to be better in stocks than they are in bonds, but that's not a high hurdle when bonds are setting at 1 to 1.5%. That's where we are today. And you have to deal with where we're at today if you want to maximize, the benefits that you're going to receive at some point in time, whether that's right now or in the future. And an awful lot of people put 100% of their money in stock. If you're in your 60s and you're doing that, I hope you are a multimillionaire. You're going to need to be to survive the next big downturn without, spending too much of your money. Anyway, I hear the music. That means the show is definitely over. Feel free to give me a call, reach out. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.